All right, let's jump right in. So you're thinking about a reverse mortgage, or maybe you've just signed the papers. A lot of people think the process is over once you get the money, but really, that's just the beginning of a pretty long journey. Today, we're going to pull back the curtain and look at the entire life of the loan, from day one to the final payoff.
Right? This is the big question that kind of hangs in the air after any major financial decision. The ink is dry, the funds are there, but now what? What are the rules? What are your responsibilities over the next, 7, 10, maybe even 20 years? Let's clear that up.
And this quote from Ryan McIntyre really nails it. Confidence comes from clarity. The whole point of this explainer is to give you that clarity. We're going to walk through the real-world stuff that comes up long after that initial meeting at the closing table.
So let's think of this as a journey. Seriously, a typical reverse mortgage is around for 7 years or more. And just like any long trip, it has different phases. We're going to cover the whole path, from the moment the loan gets on the books, all the way to the day it becomes due.
Now here's the thing that might surprise you. The most important moments, they usually don't happen right at the start. Nope. They pop up years down the road when life changes or something unexpected happens. And that's exactly what we're going to focus on today. So let's start with that crucial first year. Right after you close, there are a couple of really specific rules and responsibilities you've got to know about. Getting these right from the get-go just makes the rest of the journey so much smoother.
For the FHA-insured loans, the two big ones are, 1, some initial limits on how much cash you can pull from your line of credit in that first year, and 2, something called repair set-asides. Now let's really zoom in on that second one, because honestly, it trips a lot of people up.
And you can see why it's a pain point. A repair set-aside is basically when a chunk of your loan money is held back to pay for necessary home repairs to meet FHA standards. This isn't optional, it's part of the deal.
And here's the really crucial part. If you don't get those repairs done and have them verified, the loan servicer can literally freeze your account. They can cut off your access to any other funds in your line of credit. It's a serious consequence, so it's vital to understand that obligation right from day one.
Okay, so let's fast forward a bit. After that first year is over, the loan enters this long phase where it's not just sitting still, it's actually a dynamic financial tool. And it comes with both some really powerful features and some ongoing obligations.
What's really cool is the flexibility. The money you don't use in your line of credit, it actually grows over time, which is amazing. Plus, you can change your payment plan if your needs change. But, and this is a big but, with that flexibility comes a huge responsibility. You have to stay current on your property taxes and your homeowner's insurance. No exceptions.
Now, to help with that, some loans have a feature called a LESA. The easiest way to think about it is like an escrow account that's built right into your reverse mortgage. It sets aside some of your loan money to automatically pay those bills for you, so you never have to worry about them being late.
But here's the bottom line. Whether you have a LESA or not, the responsibility is still yours. Missing these payments is a really big deal. It can actually trigger a default on your loan. And you absolutely do not want to risk your home over property charges.
Okay, I know that might sound a little scary, but here's the good news. The program is designed with some really powerful safeguards to protect you and your family. Let's look at 2 of the most important ones.
First up, protections for a non-borrowing spouse. This is huge. The rules have gotten so much better over the years. Now, an eligible spouse who wasn't on the loan can stay in the home for the rest of their life after the borrower passes away, as long as they meet a few conditions. It's an incredible piece of security for couples.
And second, maybe the most fundamental protection of all, this is a non-recourse loan. What on earth does that mean? It's simple. It means you or your kids will never, ever owe more than the home is worth when the loan is paid back. If the loan balance is higher than the sale price, the FHA insurance fund covers the difference. Your family doesn't inherit the debt. Period. And I just love this quote because it really speaks to the whole idea here. Knowledge is power. When you understand these features and protections, it gives you, the homeowner, total control over your financial future.
So what happens at the very end of the journey? Well, eventually, every loan matures. That's just the official term for when it becomes due and payable. And this isn't some surprise event. It's the planned final stage of the loan's life.
A maturity event gets triggered when the last borrower on the loan either passes away or moves out of the home for good, like, say, into a nursing home for more than 12 months straight. At that point, the loan needs to be settled up.
And this is where that clarity is so important for the family. There isn't just one path forward. There are several very clear options. They can pay off the loan and keep the family home. They can sell the house, pay off the loan, and keep whatever equity is left.
Or if the loan is underwater, they can sell the home for 95% of its value, or even just hand the keys back to the lender, and that FHA insurance covers the rest.
Look, the main takeaway from all this isn't that you need to become an expert on every single rule. That's just not realistic. The real goal is to understand the big picture, to know what the journey looks like, and most importantly, to know how to find the answers when those questions eventually pop up.
And that kind of leaves us with one last thought, doesn't it? This whole idea of a long, hidden journey applies to so many things, not just this one type of loan. It really makes you wonder, what other financial products out there have these critical, long-term stages that we really ought to understand before we ever sign on the dotted line?